Okay, hi guys, it's our mentor out with the flu. I say once more, you know the vibes, you know the vibes, another session. Now we will be dealing with the language of Forex, and the terminologies that you're gonna meet along the course. So these terminologies will help you in case I send analysis to shortenize everything instead of writing these long words. So we'll be using terminologies as the shortcut of everything. So let's go first on the language of Forex. So we have these terminologies, or let's say the language. Every country, every province, every person has that home language. So this is the home language of Forex. So we have the first word, which is long. What is long? Long is when the market is going in an upward trend, whether bullish or in bias. So basically it means that when you see the graph going up, that means the market is going long. It's going long. When somebody says the market is going long, just know that they are saying the market is in bias or the market is in bullish. So sometimes the person might say the market is bullish. Just know that the person is saying the market is going long. It's going in bias. So the second word, it's short. So short is when the market is going in a downward trend. So bearish or sell. So basically it means that when you see the graph going down, that means the market is bearish, is in a sell trend now. It's going short. So when they say going short, that means they don't mean going a little bit of short. No, they're meaning that it's going in sellers now. It's going down. The graph is going down. So okay, our third word, it's stop loss, which is SL. So these are the terminologies you see now. We're not writing stop loss anymore, but we are saying SL. So okay, but we are not there. We haven't arrived yet at the terminologies. So let's be based on stop loss. Stop loss. What is stop loss? Stop loss is a level that you put to stop a loss if a trade goes against you. It saves or protects your capital. In other words, you can hear by the word itself, stop loss. It means that it stops the loss. So in case you are away from the screen, you put those levels, the stop loss, you put it so that in case the market goes against your analysis or how you analyzed, we have the stop loss to actually close that loss, so that when you come back, you might not find, so that you find your capital being protected, so that you find your capital being reserved, instead of when you come back, you have nothing in your account. So you see, that's the boring part now. So the stop loss is there to help us with that. So we have the take profit, which is the TP. The TP is a level that you place so that the market can close those profits automatically. Like I said in the previous word, stop loss. So this one is take profit. It takes the profit. Let's say the market went in your favor now. It favored you in your direction. So the take profit level is there so that when it reaches that level, the market can close the profits while you are away being busy. We have a busy life. You can't stay on the screen 24/7 without doing nothing. So you have to focus on your life. So that's why we have these levels, stop loss and take profit. I hope everyone understands what I'm trying to say. So we have slippage. Slippage is when the price is fast, whereby there are too many wicks or rejection of price on your chart. So maybe when you read or watch this video, you might not understand what is wicks, rejection. You see them on a chart. You'll be able to see them. They're this long, thin candles that, like, they are messy. So I'll show you video examples. I'll be talking about them, especially on the other videos that I'll be releasing, other videos that are coming. Actually, let me not say releasing, but coming, that are becoming, that you'll be learning. So you'll be seeing when I say rejection or wicks, then you'll be able to say, oh, it's slippage. He once spoke about slippage. So when you see too many rejections, just know that there's high volume in the market. There's a lot of volume that is going on in the markets. So that's why we have the word slippage. That means that is when price is fast, when there's a lot of liquidity, volume, you know. So yeah. Technical analysis. Wow. Okay. Technical analysis, that is the approach to the market any time of the week and using all tools available. So technical analysis basically is what we'll be doing most of the time. So when you analyze and say you're stating probability, remember Forex, it's all about probability. So you're stating your theory. Technical analysis is saying that sorry for that, it says that according to my analysis, I'm expecting the market to do this. Remember, it's a theory, it's not a hypothesis. So the hypothesis is when the market respects your analysis. So that means that what the theory has been proven, but proven using what? Technical analysis. So basically technical analysis is actually a theory. You are not saying that the market will go in that direction, you'll never go short or long. That means that you say, according to my analysis and my understanding, I expect the market to go short, or I expect the market to go long. So that's technical analysis. It's a theory that you implement and wait for the market to do what it do, so that you can whether say I was correct or I was wrong. So okay, remember, there's no strategy that is 100% accurate. So somewhere, somehow you'll be losing, but that's why we have stop loss, so to prevent huge losses, yeah. So let's go to the next word. Fundamental analysis. Fundamental analysis is anything related to news events, e.g. interest rates, inflation, recession. You can see that on the news, like normal news, SABC News, Bloomberg, whatever source of news you use, we have they talk about this country now, it's going into recession. So these kind of things affect the market, especially fundamental analysis. Fundamentals are the actual core foundation of the market. They move the market. Fundamental analysis. So if they say a country has a recession, we all know that the recession is bad for a country. So that means that that pair will be losing power against another. So let's say we have GBP USD as a pair. So let's say GBP is going into inflation. That means now USD will be strong. That means we'll be selling USD, we'll be going short, we'll be favoring USD, because now GBP is it's going in recession. So yeah, that's how we do it. That's fundamental analysis. Fundamental analysis, it's news release. You can read any news anywhere. There are lot of news sources. So yeah, let's go to the next word. The next word says pips. What is pips? It's what we call percentage in points. That's pips, percentage in points, e.g. 1.3051 to 1.3 thousand. So in simple means, it means that 51 pips. That means we have moved from 51 pips. If you look at the last digits, the last two digits, it's 51. We moved from 1.3051 to 1.3 thousand. That means that the market has moved from this to this with what? 51 pips. So yeah, that's pips basically. You'll see them when you do much. I prefer in these kind of states, we do things practical. Pips, these are the terminologies. So but then not terminologies but the language, but eventually you will get used to them as I do more practicals. This is the theory part, but you're gonna do more practicals on them, then you'll be able to understand each and every step of them. So yeah, let's go. Leverage. Okay, leverage is a setting given to you by a broker, but it's up to an individual to choose which leverage they want, e.g. 1:500, 1:200, 1:1000, etc. But the bigger the leverage, the bigger the risk and reward, and the bigger the leverage, the smaller the leverage. Sorry for that. The smaller the leverage, the smaller the risk and reward. So basically what they mean is that once you put a leverage of let's say 1:200, that means that the risk is small, so that if the market opposes you, you'll have less risk but less profits. So if it's high, like 1:1000, so that means that the risk is high now, so that means the risk will be high and the rewards will be high. In case the market favors you and goes in your direction, that means now you'll have greater profits. But if it opposes you, you'll lose a lot of money. So yeah, you better choose the best leverage that suits you. Yeah, let's go to the next word. Risk reward. A risk reward is a ratio you calculate to see how much risk you are willing to take and also reward, e.g. 1:2 and 1:3. So 1:2, it's 50 pips, 100 pips. So it's to 100 pips. Yeah, 50 pips is to 100 pips. You can hear by the word itself, risk. reward. So basically between the word risk and reward, we have the ratio here. Let's say risk is to reward. So same as here, 1:2. That means you're willing to lose 50 pips in order to earn 100 pips. Remember, when placing a trade, make sure that your risk is less than your reward. In other words, that means your reward needs to be bigger than your risk, because it doesn't make sense for you to say I'm willing to take a higher risk than a higher reward. It doesn't make sense. We need a higher reward than a higher risk. We need minimum risk. We need minimum risk and big rewards. That's how risk reward comes in. So that you need to balance it. If it's 1:2, that means if you are willing to risk 50 pips, that means that if you're using 1:2 ratio, that means let's say you are saying I'm willing to risk 50 pips to earn 100 pips. So same as, let me say, I'm willing to risk 50 rand to earn 100 rands. You see what I'm saying? So I have 100 rand, I'm willing to risk 50 rands to earn another 100 rand. So if you lose 50 rands, if you lose, that means you lose 50 rands. But if you gain, that means you gain another 100 rand. That means it's 200 rands. So okay, I hope everyone understands. So okay, ROI, return on investment. It's basically easy, this one. Return on investment basically means that is the amount you get after trading for a week, day, month, year, or even decade. So is the amount, or let's say the profits you have accumulated across the trading day, trading week, trading month, depending on how much you have traded. Let's say for the month you want to withdraw, so you invested, let's say, 100 rands or $100. Let me say $100. Then you earned $1,000. That means that you have earned what, $900 for the month. You have earned $900. That's return on investment. You invested $100, then at the end of the month or week you earned $900. Yeah. So we have the next terminology, the next language, which is major and minor pairs. Okay. So major pairs are pairs that are traded, which mainly is GBP, USD, USD CAD, Euro, USD, USD Chef, etc. And minor pairs are Euro, NZD, NZD, JPY, etc. So basically, you need to understand that pairs are actually what we trade. That's what I was speaking previously. I think less than 5 minutes ago, I was saying GBP, USD. So GBP, USD is a pair itself. It's a pair. So there's a video where I was explaining about these pairs, where you get after opening a demo account and everything, a practice account. So I was speaking about them, that we have GBP USD, we have USD CAD, those kind of things. So we have them. We have the major pairs, which is at the top dominators of the market. We have GBP, we have USD, we have CAD, we have Chef, which is GBP is Great British Pound, by the way. USD is the dollar, it's obvious. Then CAD is the Canadian dollar, it's a Canada dollar. Then Euro, it means everybody knows it's a European dollar. Then Chef is the Swiss francs, so it's a currency used in France. Yes. Then minor pairs, we have Euro, NZD, etc. But they are there. You can search them, you'll find them. Major pairs, minor pairs. So major pairs, you can hear by the word major, they are mostly traded. Those ones, they are mostly traded because they include high volume and high profits and risk. So yeah, minor pairs are those that has less volume, though they even pay, but they have less volume, they're less traded. So yeah, these major pairs are the ones that were actually introduced into Forex, if you look at the history of it. So yeah, I won't go that deep because I don't want to make this video too long. So yeah, you can search them by yourself, the history of Forex. So candlesticks are tools that that look like candles on the chart, that help us to be able to read where the market is going. So once you open your chart, the minute you open your chart, you'll see these candles. So those are called candlesticks, these bars. So when you look at them, they look like candles, like a candle, a normal candle that you use to light or the dark. When there's load shedding or no electricity, use the candle to light it. So they're like that. They're also like that, but you see them on the chart. They use, without candles, actually you won't know whether you should buy or sell. So you need those candles to actually determine where you are going in the markets. So we use those candles to analyze. We use those candles for technical analysis. We use those candles for, it's like the foundation of trading. Not actually trading, but for your screen, for your MetaTrader platform. So you need those to actually know where you are going, whether you're going short or long. Yeah. So broker is the company that gives us access to the financial markets. Without a broker, you won't be able to trade. So a broker is the middleman between you and the markets, the official markets. Broker gives us access to the financial world. So for you to see those candlesticks, for you to able to trade, to place a trade, for you to able to earn the profits, it's because of the broker. You need the broker as the middleman to help you access the financial markets, to able to see those candlesticks, to able to, to make those profits. So after making those profits, the broker helps you again to get the profits you have earned on the markets. Yes, that's the purpose of a broker. Same as you, as let's say, for example, a company hires you. So the company is the middleman. Actually, your boss is the middleman. So the middleman, you put the work, the middleman pays you. So the middleman also takes your work and gives it to the higher institution, maybe let's say the government, So when the government does what it does, it brings back the profits, it gives it to your boss gives you your share according to how you have worked. That's a broker. That's how a broker works. So yeah, I think we are done with last one, margin call. Margin call is when your positions are closed automatically because of overtrading. Overtrading is bad, guys. Overtrading is bad because once margin call hits, the broker closes those positions automatically, because now you have done overtrading. After overtrading, the margin falls. So after the margin falls, then you'll be surprised your profits, your trades are being closed automatically, because now your balance can't be able to, or let's say the amount you invested can't be able to handle the loss anymore. So they're trying to balance the margin so that it can't affect the balance. So the margin, it's once you see margin call, just know you have overtraded. Margin call doesn't appear when you have traded wisely. It never does that. It only appears after overtrading, saying I'm willing to risk all the amount that I have in my account. So yeah, I think we are done. Now we are going to terminologies. Okay, terminologies are words, short words, simplest words, rather than writing them as they are. So the first terminology is TP. I spoke about it. TP means take profit. SL means stop loss. Okay, POI means point of interest. OB means order block. You'll still learn. There are order blocks. I'll still teach in the next videos. I'll still teach about order blocks. What is order block? What is point of interest? But one thing I know is that order block and point of interest are the same words. That they share the same words. Some people prefer saying point of interest, some prefer saying order block, and some prefer saying S&D, which is supply and demand. Order block and supply and demand are the same thing. So some they say they prefer saying order block, some they prefer saying supply and demand, some prefer saying point of interest. So yeah, you will learn. So LQH, it's liquidity high. LQL, it's liquidity low. If you see me sending analysis, then I wrote LQL, just know it's liquidity low. If I send analysis written LQH, just know liquidity high. And IPA means insufficient price action. So same thing, sometimes I write IPA. I won't write insufficient price action. It's the longest words. These words are on the right are actually long, so that's why we use these ones on the left, the terminologies. So yeah, insufficient price action. FVG, fair value gap, and IMB, imbalance. But these three terminologies, IPA, FVG, imbalance, are one and the same thing. Some prefer saying fair value gap. Fair value gap is the same as saying imbalance. And IPA, it's up to a person. I prefer imbalance because I'll understand it much better than saying FVG. I'll forget what FVG means. So some will say IPA because I think I'll forget the word imbalance or FVG, you know. Some will say, no, I prefer FVG because it's quick for me to remind. But it's the same thing. They do one and the same thing. There's no difference. So yeah. Okay. BOS. BOS means break of structure. COS means continuation of structure. CHOCH, some will say this is physics, it's chemistry now. We are going to chemical reaction. So yeah, we are playing chemical reaction in the markets. So it means change of character. Change of character. This one, change of character, and BOS is the same thing. BOS and change of character is the same thing, but you learn it that other side. So yeah, BSL, buy side liquidity, double SL, sell side liquidity. So these ones, BSL and SSL, go hand in hand with liquidity low and liquidity high. So it's up to a person whether they want to use BSL or SSL, or they want to use LQH or LQL. It's up to you. It's up to you. So LTF, it's lower time frame. HTF, higher time frame. These are the terminologies you're gonna need in the markets. Instead of saying insufficient price action, you know this word is long and it will mess up the beauty of your analysis. So IPA, it's short, 3 words, saves a lot of space. Then you'll be able to analyze immediately. When you say IPA and you share me your analysis, I'll be saying, oh, insufficient price action, because I already know. You know, these terminologies, I know them by heart. So same as you need to know them by heart. Very easy once you do them practically. So yeah, so that's it, guys. Those were the language of forex and the terminologies. Next video is coming. I'll be explaining. I'll be going more deep and deep, bit by bit, level to level, till we reach the end of this course. So thank you, guys. Have a blessed evening.